we're going to talk briefly about some very basic cost concepts. Things I'm hoping you all have seen before, but I can't assume it. But if you all have, tell me and we'll move fast through this. So these are chapters 1 and 2 in your text. 1 and 2. Very little on chapter 1, the manager and management accounting. We kind of talked about that as part of chapter 13. And then we're going to introduce a lot of terminology that will be central to our class. A cost. A cost. It's a sacrificed resource. Money, materials, will, it's a resource to achieve an objective. A cost object is something of interest for which you want to kind of collect costs. The simplest and most obvious cost object would be a product. You want to collect all the costs associated with building a car. But you also might want to collect costs related to a customer. How much does it cost to have a relationship with a given customer? Are they a profitable customer? So a cost object is whatever is of interest that you want to collect costs about. A cost pool is a set of related cost objects. So all of your products could be out of a given department. That could be a pool, a department. Cost accumulation is the process of collecting these costs. And cost assignment is you collect the costs and then you assign them to specific objects. There are two ways that costs are assigned to objects. Some costs are easy to trace, and those are just go to the object. So if you're building a car, the metal that was used for that car is easy to trace to that car. But a lot of costs are indirect in nature, and they need to be assigned in some logical fashion, hopefully in a cause and effect fashion. And that is called cost allocation. So examples of cost objects. It could be the product, BMW, a service, maybe how much does it cost to have a dealer support telephone line. It could be a project. How much does it cost? You maybe want to have a new car to do R&D on a new car, or in this case on a new DVD system. Customers, this retailer. How much does it cost to work with that retailer, etc. So cost objects can come in many different flavors, not just the product itself. It's however you want to accumulate your costs. This picture kind of brings it all together in a really bright way. You start off with some costs. Some costs go directly into a pool department. That's your pool. That are then in some way allocated out to individual products. A supervisor would have their costs allocated in some way between the different departments, etc. So that kind of visualizes it. Now, two terms that are very important to us are direct costs and indirect costs, and variable and fixed costs. How many of you have heard of direct and indirect? A few, not everybody, good. Variable and fixed? Everybody, more or less. I'll do that quicker. Direct costs. These are costs that can be easily traced to a product or a department, wherever the cost object is. So the cost of paint in the paint department. You know exactly how much paint you put on the exterior of the car. You charge each car for the paint it uses. Indirect costs are costs that need to be allocated. in order to be assigned to a given product. So you do advertising. You have to figure out, okay, how much am I going to, charge for each seat that we sell for the advertising campaign. That cost has to be allocated in some rational fashion. That's direct versus indirect. Direct could be materials or labor, if you can assign labor directly to a product. So if you work for one of the big four accounting firms, or you work for any accounting firm, you'll have a client, you'll have a billing rate, your time that you spend on that client, you'll do some kind of a timesheet. The time you spend on that client will be directly charged to that client, a direct labor charge. And then overhead is allocated. The cost of the night watchman at the factory has to be allocated in some way. Okay, variable and fixed costs. Variable costs change along with the activity level. You sell 1 unit, it costs $5. You sell 2 units, it costs $10. It varies with the level of activity. The cost per unit stays the same. It's always $5 per unit. Fixed costs, on the other hand, no matter how many you sell within a relevant range, and we'll talk about that in a moment, the cost is the same. So the fixed cost per unit goes down as you have more activity. Variable costs, graphically, it's a line with a slope. The slope per unit is your variable cost per unit. Remember slope from high school? Rise over run. Y2 minus Y1 over X2 minus X1. It's coming back. We'll have a chapter on it. Fixed costs stays the same. Now, we show it as linear. In fact, costs are not really linear, but there's only a relevant range of data that's realistic for us to be doing business in, and within that relevant range, it approximates linearity more often than not. So we can use linear functions more often than not understand a cost function, which is good because it makes everything a little bit easier than if we have to use other functions. So a variable cost could be direct or indirect. A fixed cost could be direct or indirect. They don't have a specific relationship. So a direct variable cost are the tires, 4 tires. If you sell 1 car, it's going to be $1,000 worth of tires. 2 cars, $2,000 worth of tires, whatever. A variable cost that might be indirect could be power usage. The more cars you produce, maybe you have to do a second shift or a third shift, and therefore the power usage will increase with the higher level of production. Fixed costs that are direct, the salary of a supervisor. To the accounting firm, each of you would be a fixed cost, because at least in the short term, you're either there or you're not there. You're paid by salary. In the longer term, your cost is not as fixed because they could always choose to fire you or can give you a raise. A fixed cost that's indirect are lease costs for a factory plant. The cost of the factory plant doesn't change over time, has to be allocated in some way, and it's a fixed cost. Okay, so here's a chance for you guys, a little from me. How many of you brought your textbooks? Does every team have one textbook? Your team does. Okay, if you don't, beg another team for their Biden. Go to chapter 2. This is a very quick one. Chapter 2, question number 20 on page 53. Identify each cost as a direct cost or an indirect cost, and a variable cost or a fixed cost. Page 53, problem 220. This is a quickie. Is any team without a book? Any team with extra books who will help the team without a book? Okay, another minute or so. Do you have it on pause? You have it on pause? Okay. You got this down pretty well. You have to, yeah, you can't, yeah, sometimes the audio quality is not as good as you hope. Let's hope it's okay. Okay, ready? Remember, direct or indirect is based really upon the fact, well, direct and indirect is really based upon the fact, is it affecting both products or just one of the products? If it's indirect, it has to be allocated across the products. So, cost of tires for the geoprism, direct or indirect? Variable or fixed? Variable. So it's direct variable. Salary of the PR manager for the entire plant, direct or indirect? Indirect. Has to be allocated for both products. Variable or fixed? Fixed. The annual awards dinner for the Corolla suppliers, direct or indirect? How many say indirect? How many say direct? Direct it is. Because it's only the Corolla. So it's only dealing with, it's not being allocated to both of the products, it's only going to the Corolla product. Doesn't have to be allocated. Fixed or variable? Fixed. That's, I think, the trick question of the lot. Salary of the engineer for the geoprism. Direct or indirect? Direct. Geoprism. Fixed or variable? Fixed. He's a salaried guy. Freight costs of Corolla engines from Toyota City, Japan to Fremont, California. Direct or indirect? Fixed or variable? Okay. Electricity costs for the plant. Indirect because it's one bill for everything, and variable or fixed? Variable, it changes with volume. Wages to the temporary assembly line workers, direct? It is direct, but it's a little bit obscure because the question says that each plant has separate assembly lines, so they'd be working on one assembly line or the other, so it'd be direct to that assembly line. But you had to see that in the question. Variable or fixed? Variable. Fire insurance for the plant? Indirect fixed. Okay, we got it. That's it for that game. Okay, a few other cost definitions for us to work with. Marginal cost versus average cost. The marginal cost is the extra cost to produce one additional unit. So the marginal real cost is usually just the variable cost, because you've paid the fixed, the variable cost. The average cost is the total cost to produce all units divided by the number of units, and that's your average cost per unit. Product and period costs. Remember this? You guys should remember this. Product costs are those costs that are specifically related to the creation of the product. They become capitalized as they incur into inventory, and they become an expense as goods are sold as costs of goods sold. Period costs are those that can't be easily identified with a specific product, advertising maybe, and so they have no future value, so they are just expensed immediately as they occur. So product costs go into inventory until they're sold. So manufacturing costs are product costs, and all these administrative things would be expensed. Not going to do this. Going back to the costing, cost plus contracts. You have your product costs, that's your basic cost. Then you have costs that include design and R&D. So for government contracts, it's the sum of all of them. You know, if you're producing a new tank for the Army, it's not just the physical cost of producing the tank, it's the costs that are being allocated before that point as well. Controllable and uncontrollable costs are another cost definition that's important. To the extent possible, you want to judge an individual based upon what they can control. So you'd like to be able to differentiate between controllable and uncontrollable costs when you look at your total costs to understand how that individual has actually performed. So a restaurant manager can be judged on how well they manage the food that's used. Is there a whole lot of shrinkage and loss? But if it's a national chain, they probably should not be judged on the costs associated with advertising for that national chain. Opportunity costs and sunk costs. Opportunity costs are costs that are quite often and lost, but they're very important. It's the cost of the option that you didn't select, or the value of the option that you didn't select. So right now you've chosen to do this school. You could be earning $20,000 a year if you weren't in here. So as you probably all did mentally in your heads without realizing it, you did the net present value in your head of making the decision to come and do this program. Did you do that? I made the net present value when I went to go to graduate school because I was an animal science major, undergrad. And I was not going to be a vet. And I had to do something. It's a very easy net present value for me. But you made the net present value decision. You said, I have these future earning streams that are going to be better because of this program. But you also have to say, I gave up 18 months or whatever number of months of potential salary, hopefully more than 20,000, but still. This was your opportunity cost of coming here. A sunk cost is a cost that's already been incurred in the past and cannot change. As you're making decisions going forward, you need to consider opportunity costs and ignore sunk costs. They're of no use to you in your analyses. They're only of use to you from the perspective of they may be indicative of future costs. Bought a car 2 years ago for $12,000. It's a sunk cost. You could drive it, you could park it, you could trade it, you could sell it. That $12,000 is gone. You have the car now. That's a sunk cost. Next week we'll talk about costing systems, job costing, and process costing. Job costing. If you're an accountant or you're a management consultant, you have a job. You accumulate the costs into that job very specifically. The people who are working on that job charge that job. If you're building a custom couch, They have a bill of materials for what it takes to build a couch. And a specific job that you can have specific costs associated with. If you produce wedding announcements, it's the setup cost plus the paper for each one. So job costing is the way you account for those types of products that can be produced in a job. Process costing is really mass production. How do you account for the cost of 1 gallon of gas? It's a process. Or orange juice or soda pop. Are we in Chicago? Soda pop. Very different than in job costing. So those are your costing systems. Examples of jobs: building an airplane, just like building a couch, building a ship. All kinds of service sector. Service sector is quite a bit jobs. Go to a hospital, you're a job. All of the costs of nurses and doctors are accumulated against your hospital stay. Process costing is not just for liquids like oil or soda. Making M&Ms is a process. Delivering the mail is a process. There's no specific charge for that letter that got to your house. Okay, that's it for chapters 1 and 2. We're going to get out of here before 12:30. But not yet. So we'll break. How much time do you need to set up a new unit? Okay. Take a 30-second to 1-minute break. Loosen up. So there are homework assignments that I'm going to release the homework and classwork assignments at 6 p.m. the day of the class. So they're already out there, but they'll be released at 6 o'clock tonight. That way, the other class doesn't get an advantage or a disadvantage. It'll just be done at 6. So to the extent you want to do the work, go ahead and do.